Okay, today we're talking about Chapter 9, and we're talking about receivables. And we're talking about those accounts receivable accounts that might become uncollectible at some time. Okay, and there's no specific formula to figure out if something is uncollectible or not. Page 405 talks about different reasons that you might figure out that somebody's not going to pay you, but it's going to depend on what company you work for when an account actually gets written off. Okay? And so accounts receivable is a current asset, has a debit balance. You agree? Normally accounts receivables are collected within 60 days. Okay? 30 to 60 days is the normal amount. Sometimes if you have something more than 60 days, you might have a notes receivable, and we're going to talk about that next in the chapter. Okay? But for accounts receivable, that's money that's going to be collected from who? To be collected from your customers. Y'all agree, right? Okay? When do you debit accounts receivable, or when do you first establish an accounts receivable account? Say that again. Well, when you actually debit accounts receivable is when you create it. So when do you create it? It's before they pay you, because they're not going to pay you. They're going to come into your store and take your stuff and say, I'll pay you later, right? So it's when you make a sale. Or chapters 1 through 4 is when you actually provide a service and you would credit fees earned, right? And at that point, let's say that Mr. Smith owes us money, so we'll put accounts receivable -Smith down there for that. Then, when he pays us, when the customer pays, what's your journal entry? You get a check, you debit cash, and you'll credit accounts receivable -Smith, because now Mr. Smith doesn't owe you any money because he just paid you, right? Okay? And then in Chapter 8, we talked about an Nsf check. And if something happens and there's a bounced check, then we had to reverse that entry that we recorded when we received the cash, right? So we had to reverse that because he would still owe us money. All right? But now we're in Chapter 9. And Chapter 9 talks about uncollectible accounts. Okay? And if an account is uncollectible, then we have to write it off. Okay? And if we write it off, there are going to be two different methods to write off the account. One is called what? You remember these? One is the direct write-off method, and one is called the allowance method. We'll talk about the direct write-off method first. It's the easiest one, okay? Tell me what you remember about the direct write-off method. Okay. GAAP stands for Generally Accepted Accounting Principles, and the direct write-off method does not comply with GAAP. Okay? So we know that. And we also know that you're going to write off one account at a time. And it goes directly into what? Bad debt expense. Yes. So the entry to write it off, let me move this up so you can see it. The entry to write off an account is to debit bad debt expense, and you credit accounts receivable Mr. Smith as soon as you figure out that Mr. Smith can't pay you that money. You're going to write off his account. So in other words, you're going to move your accounts receivable that's uncollectible, which is an asset account, into an expense account called bad debt expense. How many times a year will you debit bad debt expense? Well, every time you write off an account. So we don't know, right? It could be 1 if you write off 1 account, or it could be 10. But every time you write off an account, you debit bad debt expense. Because we're using which method? Direct write-off method, and it goes directly into bad debt expense. So at the end of the year, to figure out your balance in bad debt expense, you'll have to look at all the different debits and add those up. Mr. Smith didn't pay, Ms. Morgan didn't pay, somebody else didn't pay. You'll add those up and figure out your total bad debt expense. Do you see how that would work? Okay? That is called the direct write-off method. Now, if Mr. Smith happened to come into some money after you wrote this off, after you wrote this account off, and he sent you a check, you would need to do 2 things in your books. Number 1, you would reverse the write-off. And number 2, you would record the cash that you received, as if he had always owed you the money, as if you had always had that accounts receivable open for Mr. Smith. Okay, so those are the 2 things that you would do if he in fact ever did pay you. It's called the allowance method. Tell me what you remember about the allowance method. Let me move this down. Okay. So it is approved by generally accepted accounting principles. Okay. And yes, you use a bucket account called allowance for doubtful accounts. Remember that? Okay. And also, in the allowance method, you're going to use an estimate for an adjusting entry. The adjusting entry is always the same. And what is the adjusting entry? You debit bad debt expense. Okay, and then you're going to establish your bucket account here in this one adjusting entry called allowance for doubtful accounts. And you're going to always do this adjusting entry when? Think back to those steps of the accounting cycle. The first thing we do is we analyze transactions and we create those journal entries. That was chapter 1 and 2, remember? Okay? And after we create the journal entries in a book called the journal, then we post those to the ledger. Then we create a trial balance called the unadjusted trial balance. Next, we create adjusting entries. And the purpose for adjusting entries is to bring your expense accounts and your revenue accounts up to date so that your financial statements will be correct. Y'all remember that? So adjusting entries happen after the unadjusted trial balance, and then you're going to make an adjusted trial balance. Then you create the most important step, financial statements, right? So adjusting entries are made right before those financial statements are made to make sure that they're correct. This is an adjusting entry. Happens one time a year. So in the allowance method, how many times will you debit bad debt expense? Chris? Now in this method, how many times will you debit bad debt expense during the year? Once, right? Okay? One time. Why? Because you only use bad debt expense for an adjusting entry that only happens one time a year. Then, when you write off a specific account, let's say that we figure out that Mr. Smith is not going to pay us, we write it off through the bucket account. Well, what in the world's a bucket account? It's called allowance for doubtful accounts. And the adjusting entry actually creates this bucket account called allowance for doubtful accounts. And then as we write off individual accounts, it decreases our allowance account. Okay? So if we write off an account using the bucket method, using the allowance method, then we will debit not bad debt expense, but what? Allowance for doubtful accounts, and we'll credit accounts receivable Mr. Smith for the amount that he owes us, because we're not going to be able to collect that account. And so every time you write off an account, it goes through the bucket account and it decreases the allowance account. Now let's talk for just a minute about what the allowance account is. First of all, accounts receivable, it's what type of account? It's an asset account with a debit balance. So allowance for doubtful accounts is actually a contra asset or a contra receivable account, and it's going to have a normal credit balance, but at the end of the year it's just going to depend. It could have a debit balance or a credit balance, because it's going to depend on whether your estimated amounts were more or your actual amounts were more. When you first establish your allowance for doubtful accounts in that adjusting entry, you're going to have a credit balance that represents your estimated bad debts. Then, during the year, when you write off accounts, you'll debit that. Every time you write off Mr. Smith, Ms. Morgan, Parker, whoever else, right? All the people that don't pay you. And so at the end, if you have a credit balance, that means you overestimated. If you have a debit balance, that means you underestimated. Yes?
Well, contra
it goes against. Okay? And that's a good question. The contra asset means that in the balance sheet, you would list your accounts receivable, and then you would say less allowance for doubtful accounts, because it goes against. So in the book, they tell us if you have $200,000 of accounts receivable, and then you estimate that $30,000 will be uncollectible, then how much are you probably going to collect? $170,000. Does anybody remember what that's called? The initials are NRV. Net realizable value of accounts receivable. So it just goes against how much you're really going to collect.
But it's still under the asset.
It's just called a contra asset because it goes against that. Okay?